one of the things that you sent through as well, Chris, was just this idea of um, building a property portfolio first, and then using that to buy shares, using that debt to buy shares. A lot of our listeners would know basically what equity is, but maybe you can explain this phrase, because we're kind of switching equity to debt to buy shares, which are also called equities. So it's kind of
Yeah.
like all over the place.
Yeah. So, I mean, one of the benefits is the property market is, a big asset, right? You're talking $9 trillion, and the debt on that is around $2 trillion. And so what Andrew spoke about in his thing was, it was an insight to say, look, it is too big to fail. The reality is our economy is built on it. The financial wealth of all households, their biggest asset is property. And so if you start playing with that, you start changing the mentality of the Australian consumer, right? And the Australian consumer drives our economy, et cetera. So what banks will do is will treat property differently as an asset class in terms of what they're willing to lend on, right? And so if you go into walk in to buy property, a share portfolio, no bank's going to want to lend you 90% on $1 million portfolio of shares, and only putting in 100,000, right? They're not going to say, I'll give you 900,000 to buy $1 million of shares. But with property, they do it every day. I mean, we don't really like to encourage clients to borrow more than 90%. We don't even do loans over that. We just think it's important for clients to get to that 10% deposit because of the LMI sort of savings. But let's say a client does buy, just use round numbers, $1 million property with a $900,000 loan. That's in 2021. As over time they pay down that $900,000 loan, and the property value goes up. It might go up because they might do renovations to it, but it just might go up because the area is shifting in terms of price. And at some point, though, the value of the loan decreases and the property value goes up, and you start to build equity in the property. Now, equity is always something that's often misunderstood, because people say, well, if the property is now worth 1.2 million and my loan's now 800,000, you go, oh, actually, I've got $400,000 of equity. I could borrow, that to buy shares, etc. Well, no, because the bank needs to protect themselves. So what they'll do is they'll lend generally up to 80% on the value of the property. And so in this situation, that person's got a $1.2 million property. 80% on that is 960, right? And they've got their loans now 800,000 because they paid down that $900,000 loan down to 800. So this person's in a $400,000 equity position, but from a bank's eyes, that's only 160,000 because of they reducing the property value to 80%. So what that person could do, depending on their income at that point in time, they could withdraw $160,000 to go and buy other investments. They could use it for a deposit on an investment property, and then go and borrow 80-90% on the investment property, or they could use that 160,000 to buy shares. They could use it to do further renovations, and hopefully they never go and use it for lifestyle spending, which like buying caravans or going on holidays, which definitely does happen. Houses do get used as credit cards. Unfortunately, it's not something we encourage at all. But in that situation, someone could then use that 160,000 to go and buy shares, right? And that would make a lot of sense from a tax point of view, because what you would have is $160,000 going into shares, but also $160,000 of deductible interest. The interest on that $160,000, let's say it's $5,000 a year, would be used in your tax return, would be a deduction offsetting the dividend income that those shares would provide. So it's negative gearing shares. And why that makes sense is because this person's got a home debt that's still outstanding, that $800,000, what they want to be doing is putting all their money into paying that off, because that's non-deductible. And then as they get equity, they want to be using that to sort of buy other things. And so that sort of gives an example. Why you wouldn't go and buy shares with cash is because it'd actually be better to pay off the home and then redraw on your mortgage to buy the shares and have lower non-deductible debt, which is your home, and then more deductible debt, which is your shares.
Mm. And do you think it's even more important that people know what they're doing when they're investing if they're using this debt to do so?
Absolutely, because people naturally have a short-term mindset, right? A lot of people are thinking very positive around shares right now. And I was a financial advisor for 13 years, and I'm a massive believer in the long-term benefits of shares, right? But I do know that behavioral economics, which you've had, Daniel Crosby on a few weeks ago, right? that all those sort of things kick in, right? And so I think when people start buying shares, the emotions take over, unfortunately, and they get overconfident, or they react sort of irrationally when times are things. So I think you've got to be really careful. And I'm not a big fan. When I was a financial advisor, not anymore. We focus solely around the property decision. But is drip feeding into the market, dollar cost averaging, and just slowly building that portfolio. And I don't really believe in terms of really selling it. If I'm going to go and buy $100,000 of shares, in my mind, it's money that's going to sit there for a long time. And so when people are pulling equity out, we've really got to then go invest it wisely longer term, and don't sort of fall to all this sort of emotional stuff that'll kick off pretty quickly, because you'll start seeing that portfolio value every day.